95% of financial advisors will tell you to live by the 4% rule, where you can withdraw 4% of your money every year and your portfolio will get you through the rest of your life. Now, if you retire in a good year, you feel set for life. You retire in a bad year, and you might be looking for another job in your 80s. The same portfolio, the same withdrawal rate, totally different outcome. That is the hidden flaw in the 4% rule, and it shows up at the exact moment that you need your plan to work. Now, today I'm going to show you why the 4% rule quietly fails for ambitious investors and how wealthy families structure evergreen income so they are never forced to sell assets to fund their lifestyle. So if you care about financial freedom and legacy, stay with me. My name is Brad Johnson. I'm the founder and CIO of Evergreen Capital. We work with high earners and families, typically 7 to 8 figures, who want to compound wealth after tax and not just grow a number on a screen. Today we're going to cover the real weakness in the 4% rule, why sequence risk matters more than average returns, and the 3-part Evergreen Portfolio Framework that wealthy families use, which includes a missing piece that most portfolios don't have, and this helps remove a lot of financial anxiety, and it gives people the freedom to take bigger risks in their career and their business. All right, the 4% rule and the problem it misses. Most people are given a 60-40 stock and bond portfolio. They withdraw 4% every year, as the model says they can, and they think they should be fine until they pass away. And unfortunately, should is doing a lot of heavy lifting in that sentence. That may or may not happen, because the problem is that the math is not wrong. It's that the rule ignores a couple of big points here. One is the sequence of return risk. Here's what that means. If you retire and markets fall early, you're forced to sell assets at depressed prices to fund your lifestyle. Once you sell, those shares are gone forever. So even if markets recover, you are recovering with fewer shares than you had before the market turned down. That damage compounds. Just like great returns compound higher, bad returns obviously compound lower. That's not a great time to be selling. This is why 2 people with the exact same net worth can do the same responsible thing, and one is fine and the other runs out of money in their 80s. Why this matters in real markets. Now think about the years 2000, 2008, 2022. Those were rough years in the stock market. The market was plummeting, down 30% often. Imagine if you had to sell stocks those years to pay for groceries. You don't want to be paying basic expenses to maintain your lifestyle by selling shares. If you retired right before one of those events and you depended on those withdrawals, your plan is exposed. Not because you were reckless, not because you made a bad decision, but because your lifestyle actually depends on smooth market returns early in your retirement. Now, markets do not care about your retirement date. They're going to do their thing. And so this is standard vanilla advice that most advisors recycle because it scales really nice for their business. You give a standard portfolio to all of your clients, you rebalance it quarterly. It's the same playbook for everyone. Now, they won't say it, but most want to be McDonald's. They want to serve the same simple portfolio the same simple way to as many people as possible. But when you ask the real question, how do I fund my lifestyle without selling assets in a downturn? Most firms do not have a great answer for that question. However, if you're worth 50 to 100 million, you're going to get a lot of solutions to that problem. You're going to get customized portfolios filled with unique investments to address specifically that problem. So this is the wealth management advice gap. Below a certain asset level, you get basic personal finance advice. At 9 figures, you get the whole family office. You get the best investments, the best advice, unique custom solutions to these issues. In the middle, where most successful people live, you still just get this cookie cutter portfolio and an asset management fee that keeps increasing even though you're in a couple Vanguard ETFs and anyone can manage those. Are you diversified? Probably not. Are you engineered for income resiliency? Almost certainly not. So here's the principle that changes everything. Ultra-wealthy families do not fund their lifestyle by selling assets. They might borrow from those assets, but most of the time to pay for ongoing living expenses, their vacations, their housing expenses, their charities, their ambitions, they're not funding those by selling stocks. They are funding that with income from their portfolio. Now, this single shift buys a lot of time, flexibility, and control in your life. It can also be even more tax efficient, because that's how real legacy wealth is built and passed on to your family, your heirs. We call this the Evergreen Portfolio Framework. It has 3 categories that work together like a machine. Category 1, growth. This is for long-term compounding, private equity, growth-oriented assets. Most investors put 100% of their net worth in this bucket, which is better than not investing, but it's certainly not ideal for most people. Category 2, capital preservation. This is about stability and liquidity. high quality bonds. The goal is not to maximize returns from this bucket. The goal is to avoid forced decisions. Category 3, income. This is the missing piece in most people's portfolio. This isn't low-yielding bonds from the government that could be inflated away by the money printer. Examples of the income that I'm talking about include real estate, private credit, GP stakes, which is a unique way of owning private equity firms themselves and participating in their management fees. This also might include real estate debt, and maybe even infrastructure, which has a history of non-correlated durable income. In other words, it tends to do quite well regardless of what the stock market is doing. And so this is not about chasing yield, as some people do with goofy things like covered call ETFs that just end up returning your capital, but it looks like a high yield. This is not extremely high-yielding debt that is backed by shady assets. What I'm talking about is institutional quality private assets run by large top-tier fund managers. You want to focus on quality in order to build a system where your lifestyle is not dependent on perfect market timing. When income covers a meaningful portion of your life, growth compounds uninterrupted, you get to rebalance your portfolio, and that becomes way less emotional because the downturns don't affect you as much. You have that income coming in, and therefore, the market being down becomes an opportunity instead of an emergency. You get to lean into that weakness and buy things on sale as opposed to selling your stocks that are down in a market that's crashing. So for example, assume you have a $3 million portfolio and you have a traditional 60-40 structure, 60% stocks, 40% bonds. That's $120,000 of potential annual withdrawals by selling stock each year. At least that's the plan. In the first few years, assume it's strong. Everything looks good, withdrawals are happening, the market is outpacing 4% a year, your portfolio keeps growing, right? All good. Confidence is rising. But what happens if the opposite scenario happens? Same portfolio, same 4% withdrawal rate, but now your early years of your retirement look like 2000, 2008, or 2022. Now you're selling into major weakness. Your portfolio is smaller than when you started. You're not so sure it's even going to last you as long as you thought. You start worrying about how long you're actually going to live if you're going to outlive your money. And it's really bad if you start thinking, well, maybe I'll pass away a couple years earlier and then I won't run out of money. I assure you, this is not what you want to be thinking about at 3 a.m. in the morning during your retirement. You don't want to be thinking about canceling vacations just because the market is down that year, because nothing is guaranteed, and that includes the 4% rule. At the end of the day, it's a timing bet. You're hoping that the timing, the sequence of returns works out for your situation. But wealthy families are not building a legacy on timing bets. They are diversifying into investments that create an all-weather portfolio that's going to work for them regardless of what's happening in the stock market. All right, so where do you start? Step 1, map your portfolio. You want to break out your current assets into growth, preservation, and income. Most people are just, once again, heavy growth. They're light preservation, and most of the time there's 0% income. Step 2, you want to address concentration. If tech has a big drawdown, you don't want to panic sell. And we see a lot of portfolios that have extreme concentration to technology, AI, Mag 7. It's been on an amazing run, but that is not a resilient portfolio that could withstand a lot of surprises. All right, step 3, build income intentionally. You don't have to do it all at once, but you want to start increasing these income streams that come from your investment over time, because you want this predictable income to protect the growth side of your investment portfolio. All right, step 4, you want to build the system. You want to include tax planning, detailed reporting of these assets, including when you're getting the distributions, what the returns are, and you want to track your net worth over time. And then you want to layer in decision rules so you know exactly what to do when the market gets volatile. Because most investors do not fail from lack of intelligence. They fail from lack of structure, lack of preparedness. They fail when emotions take over. All right, so if you have at least $2 million of investable assets and you want help implementing this Evergreen portfolio, use the link below to book a call with our team. If that's not you, we still have resources for you below. If you enjoyed this, you'll like those. Thanks for watching.